Hello, people. This is Dr. Wang here recording. In this episode, we're still going over a textbook, case 17, which is about the Boeing Corporation headquartered in here, Chicago. And it's about their capital budgeting plan for another aircraft model, Boeing 787. Okay, it's a very interesting case, and you can read the background introduction. So basically, the starting year of the capital budgeting was 2004. At that time, there was terrorism concerns, and also the SARS broke out in China, which could affect the Boeing's sales because all the airlines were in jeopardy and their demand for aircraft definitely get affected. The situation is more like today when we're all affected by the coronavirus. All global travel and domestic travel were affected, and the Boeing company is definitely on the top list of the government bailout. All right, so the Boeing company, as far as I know, they have a very high leverage, meaning they have a lot of debt, mainly through corporate bonds. Their corporate bonds are rated pretty high. I mean, it's a risk bond, a good bond, rated as A minus. But the thing is, their leverage is about 90%. So for 100 million assets, there are $90 million worth of debt. So it is a pretty high leverage, and it's definitely put the company in a very thin situation. So the financial stress we're talking about here is pretty high. So that's why whenever a shock like a coronavirus happens, Boeing company needs the cash flow, otherwise it will not survive. So in this case 17, we are working on the model. Actually, there are two models under the category of a 7E7, the original one and the stretched one. So I assume the stretched plans have longer wings. And if you look at the textbook, in page 271, which is about Exhibit 8, actually that exhibit lasts for one, two, three, for 4 pages. So you can see all 4 pages are for this table only. All right, so this is an Excel version of that. So the entire thing, let me just show you. You can see there are a lot of numbers here. So that's going to be something we work on today. But don't get scared. Don't get scared. That's why we have Excel here. So everything, as long as you have done all the formulas in the right place, maybe just one column or several columns, the rest of the table is just a matter of dragging. So it's not that complicated. And I would say this case is considered an easier one, especially when I give you the numbers for depreciation. So you don't have to take care of this part of the depreciation table. And you only need to take care of this year's for the capital budgeting. All right. So the table is already available on the canvas, and you can see this is the one you are looking at. All right. I have given a lot of numbers for you already. So you just need to fill in whatever is missing. Okay. So that's going to be your task. Alrighty, let me put away the textbook and just take a look at this capital budgeting case. So let me just zoom in a little bit and let me explain all the information you need here. So this is the project. So the project could be a lot of things, a new store, and in this case, it's a new product model. So the price is given here. Based on the price, you can calculate the sales. So under this line of products, you have the original 7E7 and also a 7E7 stretch. And the cost of good here, to my surprise, is pretty thin. I mean, the cost of good is pretty high. The gross profit is pretty thin. The cost of good is 80%. So for every $100 million Boeing makes sales, they only make 20 million for operating profit. So that's not that great. perhaps they have a very fierce competition against Airbus in Europe. Anyways, and if you look at their working capital requirement, so you know that working capital is about cash, is about inventories. So we learned a lot about this from the profit episodes. So this is pretty essential for the business in the short run. And you have also general selling administrative expenses. That's also a percentage of sales. So as long as you can calculate the sales based on the prices and also the units of a sale, you can get the total number in dollar figure of sales and then get all these expenses. And you have a depreciation development cost, which lasts from 2004 and 2009, because this is the time the project kicks in. Instead of having 1 year to start, okay, normally in our previous cases, we have a year zero when we do the investment, and then we have a year one, two, three, four for the cash inflows. But in this case, we're talking about a 30-year project. So the initial investment stage lasts for 4 years here. Okay, just for your information, instead of only year zero to put down the money, you have 4 years to put down the money. And then you have a total numbers of plans to sell. So you have 200 and 2,500, all right, for from year 1 to year 20, and then after that you have the fixed amount of units of a sale, and that's the same as the 20th year. And you can see that the sale of the sale volume per se keeps changing because the at the beginning of the project the production volume is kind of limited, and then it keeps growing and on until it reach the fixed amount and then just go flat. You also have inflation here, which is 2%, and you can see that the price here would keep up with the inflation. So that means the price of each year should be different. And you have an effective tax rate, which is 35%. And I think that's a pretty high. In this country, corporate tax is very high compared with other developed countries and developing countries. Sometimes developing countries, the tax rate could be lower, but in US, that's 35% is pretty high. It may be because the companies are so successful, and also that this high corporate tax rate push a lot of companies to be headquartered overseas. So if you look at Apple, if you look at Citigroup, or even Nike, these are essentially offshore companies, although their major headquarter and major businesses are in the United States, but they have a headquarter overseas just for tax evasion purposes. If you are interested, you can check on that part. All right, anyways, so let's also look at the starting year of the production is in 2004, but it takes 4 years to do the aircraft production. So that's a quite long process because we're talking about something flying in the sky, and definitely safety is a very concern. So perhaps that's the reason it takes a long time. All right, you can see that this two model would be delivered starting at different years, one in 2008 and another in 2010. And these are their initial price at the time of the first delivery. Okay, so right here, as I said, the total number of delivery of plans keeps growing. As you can see, it has a percentage going on, and there's some calculations, there are formulas regarding to this percentage, but you don't need to worry about it. Okay, just don't need to worry about it. This is something decided. This amount decided by the corporate managers, and it's more like an operating concern instead of a finance concern. All right, so I really want you to focus on the financial part of the story. So this is the project year. So we are at assume we are at the year 2004, and then these are the future years. So there's 2005, 2006. So these are all calendar years here. And the first delivery is made in year 4. The project year 4, uh, but it's the calendar year of 2008. So you have this cumulative plans delivered, and it is made up of two models. Okay, so let's say in the year of 2008, the company delivers 30 airplanes, and that is made of 30 original model and 0 stretch model. And then the next year, 108 for the from the original and 0 from the stretch. Because on top it says the stretch was not delivered until the year of 2010. All right, so this is the number of delivery, but you should know that it comes from this percentage. Okay, it comes from this percentage. Okay, so if we look at the price, right? As I said, it's inflation adjusted price. So if you look at the price right here in 2008, this is where you should do some typing. It equals to the price on the top, right? On the top. And the initial year for the stretch model is in 2010, so it's right here, just to make them connected. All right, if you don't make numbers connected, then if you do a lot of advanced analysis as what we did for target, then you wouldn't be able to do it if these are kept as numbers instead of the formulas as I did here. All right, so let's put inflation in our consideration. So the price next year equals to 1 plus this inflation of 2%, and make sure you lock that 2%. Hit F4 or manually tap the dollar signs, and you can drag it. So each year the price is the previous price multiplied by 1 plus inflation. And then it's just a matter of dragging, dragging, and dragging. All right, for the next one, the stretch model. Plus 2% again, locked. All right. Let me just shrink myself so you guys can get a better view. Okay. Although I think I'm a good looking, but it's more important for you to see the work. Okay, so the total revenue, you need to incorporate not only the price, but also the units of sales, right? For example, this 77 price will be multiplied by the number of plans from a 77, okay? And also the stretch model price times unit. And you don't need to lock anything because you have to drag it and keep shifting all the reference sales. Alrighty. Okay, so cost goods sold. It's in dollar figure, and you should know that it comes from the 80% cost goods sold ratio. So 80% of that ratio is basically 20% of gross profit margin, which I think is pretty thin. Well, if that's the way it is. Okay, the gross profit here is the total revenue minus cost of sales. Okay, so which product has a high gross profit margin? Definitely popcorns, as we learned earlier, and also sweet pea candy classes. All right, the depreciation. Okay, you can see the depreciation actually comes from the year of 2004. All right, although you did not make a sale until 2008, but capital investment already occurred in the year 2004, 5, 6, 7, and 8, 9, 10, and so on and so forth. Because each year the company is making long-term investment. So we're not talking about buying another building. We're talking about replacing equipment and upgrading the production line, and also change some cargoes and also um, the transportation vehicles. So each year it will require more money for that. So you will see this capital expenditure made in these years. By the way, every number is here in the million. For each airplane, they can sell for like $10 million easily. Okay, so starting from 2004, which is year zero of the project year, the company makes $100 million investment, and then these are the investments, so on and so forth. And the investment did not finish until the year 2037. Okay. All right. So this is a table of a depreciation following double declining balance. I did not put any formula here because I think the depreciation method is really an accounting subject. So for this finance class, we can skip that. So, but still I need to explain why the numbers are laid out like this. Let's say if the company in 2004 make an investment of $100 million, then in 2004 itself, the depreciation would be 7.5, and then in 2005 it will be 6.94. So all the numbers in this row will apply to the $100 million investment in the year of 2004. Okay, so this $100 million investment, capital expenditure, you can call that too, last from 2004 all the way to 2023. All right, so it's a 20-year depreciation period for each of the equipment or property the company purchases. And for 2005, the company makes 300 million investment, and depreciation did not start until 2005. As you can see, it also lasts for 20 years from 2005 to 2024. So that's 20 years. And then from 206, it's another, well, it's a big number. It's a $1 billion investment was made, but you see the depreciation did not start in 2004, did not start in 2005, but it started in 2006, and then last for 20 years. So for each of the new equipment or property purchases in the capital expenditure, the depreciation starts at the time of the purchase. Okay, so that's why you see this table following this shape. Okay, so you can see a lot of expenditures, and they each last for 20 years. So that's 20 years of depreciation numbers, and then you can see it all shift to the right. But all the numbers from here and then moving forward, they do not matter because we only look at the capital budgeting up to this 2037. Okay, this is 2037. Okay, for all the years after, we don't care. All right, we leave it for the new capital budgeting plan, which starting at 2037. Okay, so with that being said, let me just count for depreciation. So in 2004, your depreciation is what? It is actually the summation of all the numbers down. Okay, so in 2004, you only have the one number in the column. Okay, just put it in there, and then you just simply drag it for 4 years. Actually, you can drag it for the entire row. I don't care, but I want to explain this. Where do you get this 29.44? So depreciation in 2005 is generated from two expenditures. Let's say in 2004 you bought a production line. In 2005 you bought a vehicle, and then so in 2005 this the total depreciation here comes from the production line purchased a year earlier and the vehicle you purchased in the current year. And in 2006 you have the depreciation generated from the production line purchased 2 years earlier, and and also the vehicle purchased a year earlier, and also whatever you spent for in this year. Okay, so each year the depreciation is coming from different properties the company bought in the current year or in the previous years. All right, so that's why we need to use the summation. Okay, so this is the depreciation. And then the GSA expenses, it is 7.5% of the sales. So let me just put 7.5% in there, 7.5. Don't forget to log it, times the total number of sales. This is my total revenue. Okay, and then just to drag. Okay, and then operating profit here, it would be your gross profit minus your depreciation minus the GSA expense. All right, and drag it. Actually, when you finish editing all of the items here, you can just select them all and then just drag it all the way to the last column. It does not matter whether you drag it one by one or drag it in a group of 4 in the same column. Okay, so for the pre-tax profit, all right, this is a tricky part. Your pre-tax profit, from here, it can be easily calculated as this gross profit minus all these expenses. Okay, just say the sum of them all. Oh, I'm sorry. It's the operating profit. It is the operating profit minus the R&D expenses. Okay, and operating profit is gross profit minus depreciation and the GSA expenses. And you also need to consider all this. Okay, you need to consider all the numbers happened before. Okay, although you have a 0 operating profit here, you can treat them as zeros for the time being. And also the gross profit put as 0. Okay, so you have a 0 expenses. So for the operating profit here, actually it is not 0, I'm sorry. You just drag it all the way backward. So it is negative. So you had not make any money from selling aircrafts, but you did have some depreciation incurred on your income statement. Okay, and also you need to deduct this R&D expenses, which were planted there before you start the project. So just take it as given. So those are the pre-tax profit. Definitely those are losses. Alrighty, and the taxes, you're gonna multiply this number, whatever is it doesn't matter whether it's a loss or profit, multiplied by 35% tax rate. Okay, so it's a negative tax, meaning you are getting tax credit, all right? And the tax credit could be carried forward, which means although it pays 0 tax, well, let's say if this is what it shows on the income statement, you give it to the IRS, you give it to the SEC. But today, the IRS are not giving the company any money, right? But this credit could be carried forward next year to to cancel some of the positive cash flow you paid for taxes. All right. So if it's next year, then if you pay a lot of tax, and this would offer a deduction of the tax you pay. Okay, so this is a tax credit. And then just to drag it all the way. Okay, and then the after-tax profit. So I will use this pre-tax profit minus the tax credit or loss, and then drag it all the way. Okay, so you can see that the company definitely is losing money for the first several years, and then it will start make money in the sixth year of the project. So it's a really, really long-term investment. So only for a gigantic corporation, Boeing, can handle this a long period of a product cycle. And then you need to, this capital expenditure is given here, but rather I want you to redo it, okay? Just redo it, because I want you guys to know where the capital expenditure comes from. You see, this is the capital expenditure made in all these years, starting from 2004, the initial year, all the way to the last year, 2037. So I want you guys to copy this column of number and then paste in the row. How do you paste a column number in a row of numbers? So just paste it, and in the paste special, click on paste special. I want you guys to hit transpose. Okay, transpose. All right. So this would give you the capital expenditures of each year. And then you need to add back depreciation. So whatever depreciation you had earlier, so just make them connect. Okay, make them connect. All right. Maybe it's time for me to check with the textbook, but I have this number right here, just to double check whether that's correct or not. Alrighty, change in net working capital. This is working current capital. So it is not really mentioned here, but I want you guys to create a new row and record that as net working capital. And how do you get net working capital? You see that the working capital requirement, okay, which is your net working capital, is a 6.7% of the sales. So you just use this 6.7% on the top, lock it, multiplied by the total revenue. Okay, the total revenue right here. Okay, so for the company in the year of 2008, if it wants to produce a $4.1 billion of products, then it has to maintain this much of an inventory or account receivable or cash in its account, okay, in the current assets account. And then you can just drag it all the way. So as you can see, when the company makes more and more sales, the net working capital required would be higher and higher. But what really matters in the capital budgeting table is the change of net working capital. So from this year to this year, you see that the net working capital comes from 0 to this $275 million. So really it is about reducing cash, okay? It's about reducing cash. So let me put 0 minus that, okay? So to build up this much of a net working capital, you need to spend this much of a cash. I know that net working capital includes cash, but you have to put there, make it available from the company's cash reserve. So still, that's some cash outflow, which is negative. And then you can just drag it all the way. Okay, so in the next year, in the next year, it should be whatever you had before minus the net working capital in the new year. All right, we have I have explained this many times before. You can treat net working capital as inventory. Okay, let inventory to represent that. If your inventory keeps increasing to maintain the enlarging sales, then definitely you need to buy more and more inventory, and that's gonna cost you more and more cash. So when inventory increases, your cash will go down. So that's why the outcome is negative. Actually, for this one, I can just use the previous formula. Okay, make it the previous number minus the sales right here. The working capital. Sorry, and then drag it all the way. So each year, each time your inventory changes, you will need to spend money for the increase of inventory or receive money for the liquidation or decrease of inventory. And then you can consolidate. Okay, you can consolidate. For the annual free cash flow, it is made of 4 parts. You don't have a salvage cash flow, so you have only one part, which is the negative capital expenditure plus the change in net working capital. Well, there's nothing here because we have no sale, just to add it there. And then plus the operating cash flow. Your operating cash flow would be the net income or after-tax profit, which does not incorporate interest, plus the depreciation add back. Right. So since this is really within the cash theme, if depreciation was deducted, you have to add it back because depreciation is not a cash. You have to take away the effect, but it does help you save some taxes. Alrighty, then you drag it all the way. Okay, so that's the consolidated free cash flow for each year. Why does a company call it free cash flow? Because that's a cash flow distributed among the investors, all right, among the investors. It is after taxes paid, after all the expenses get considered. It's after the depreciation effect that canceled. So this cash flow is for the investors, either for the bond investors or the stock investors. You can calculate the NPV of that if you have the cost of capital. You can see that for Boeing company, the cost of capital would be pretty low. 90% of its assets is dominated by bond, and their bond has a pretty high rating, which means it's a safer asset. In the finance, high risk, high return. Investors want to be compensated for higher risk they're taking by higher return. But if Boeing company has lower risk, then investors would require lower return. So the yield of a corporate bond issued by Boeing would be lower than most of the bonds in the corporate market. Okay, it's definitely higher than the T-bills, but it's a lower yield bond just because it's pretty safe compared to other companies, of course. All right. There's no working network WACC or weighted average cost of capital given here, so we can't really calculate the NPV. But what we can do is to calculate the IRR, which is very easy for us to do. You just put IRR here and then select all the cash flows in the capital budgeting period, then hit enter. Okay, so that's a 16 point, it's actually 15.66%.